Hey guys, today we're going to start a new chapter about finance and accounts. So it's the third chapter, and we've already done one of the chapters when we talked about costs and revenues. But with the first one, the one that we're going to cover today, we're going to introduce ourselves to finance to sort of like get a general understanding of why finance is needed and what are the two different purposes of finance. So really, chapter is quite short. We have to, at the end, you have to understand the role of finance for businesses in financing capital expenditure and what it is capital expenditure, and also its role in financing revenue expenditure. So let's get started. The difference between capital and revenue expenditure. So capital expenditure, the definition is purchase of assets that last more than 1 year. And a typical example would be machinery and buildings. On the other hand, revenue expenditure is spending on all costs and assets that last 1 year and less. And some typical examples would be salaries and materials bought. So the first sort of difference is what you're buying with your finance, or what is your spending um, directed on, and the second difference is for how long are you going to be using the assets that you buy. Um, let's go in more detail, and first let's talk about capital expenditure. So capital expenditure, once again, is any finance, any spending that we make when we are buying fixed assets. Now here we're already using new terminology. Maybe the word asset is new. The word fixed we already seen when we talked about fixed costs. And together the term fixed asset means any sort of item of value which provides function for the business and can be used repeatedly. Also, how it's defined is that it is used in production and it lasts for longer than 1 year. We're using it not in the short term, but we're using it in the long term. So it's very important the part, because sometimes it's also called non-current assets. So it's very important in the definition of the term fixed assets, the fact that we are using it for a long time, that it's a long-term, um, that it has a long-term function for the business. Some examples of things that we can buy, which would then fall under the category of capital expenditure, would be land, that is a fixed asset. It would be a building that also we're using for long term and repeatedly, equipment, machinery, commercial vehicles. So here some pictures to sort of illustrate it. Notice the use of the word capital. We've seen it before. We've seen it when in chapter 1 when we were discussing different factors of production. As you remember, capital was defined as any sort of finance, all the money used in production of products, and also all the machinery or all the equipment used. So here, again, we're using the word capital. And the second time when we use the word capital is when we were defining different types of products. One of the goods were capital goods, and the second type of goods were consumer goods. What was the difference between these two terms? So this is some revision. How do we define capital goods? Those are goods that we use in production in order to produce other goods. So in this case, for example, this machine we are using in our factory, in our warehouse, and the purpose is not to serve the final consumer, but the purpose of this machine is to produce other goods, either other, let's say, um, capital goods or other, let's say, consumer goods. So now back to the word capital expenditure. It's any spending, yeah, expenditure. We can say another word of expenditure is spending, any spending of finance on buying those capital goods. And capital goods could be those fixed assets that are used in the long term by the business to provide some function for the business and to produce other goods. Capital expenditure, as I said, the very key sort of word or key idea is the fact that those assets that we buy using this finance are going to be used in the long term. And that pretty much, if you know that a certain company, certain business has some amount of capital expenditure, so here we're talking about some kind of number. Yeah, let's say that, okay, our business is spending 1 million crowns. That is on capital. So they're buying some fixed assets, and that is their capital expenditure. If you know that about the business, it also gives you other information. So it determines the scale of operations of the business. When we say 1 million, is that a lot? Is that a little? It depends also on the industry, but very much it will tell you how big is the business. Is it operating on a big scale? Is it using economies of scale? Is it a small business? Are they likely to use flow production, or are they likely to use job production? And the second thing that it tells you is that in order to finance our capital expenditure, we need to have some long-term sources of finance. Okay, so if I'm spending a lot, if my capital expenditure is high, then I probably have some also big source of money, of finance. So that is going to tell me that the business that I'm observing probably has some long-term or uses some long-term sources of finance. In order to get long-term sources of finance, we often can provide collateral in exchange. Very often, the collateral can be the machine itself, the asset itself, the one that we're buying. If we don't pay for it, for our long-term source of finance, if we don't, for example, pay for our debt, then the bank that gave us the money in a loan can take the machine back as a collateral. So collateral can be defined as an asset acting as a financial guarantee, and its purpose is to secure additional loan capital. A lot of new words here, throwing a lot of new words, but don't worry, we're going to, keep on using these new words. We're going to keep on using the word asset, loans, capital, collateral. So you'll get used to it. But the key thing to remember here is that the capital expenditure is long-term and often tells us a lot about the business. Now, what are the reasons? Why do businesses care about capital expenditure? Why would they be spending on these long-term fixed assets? Obviously, if it wouldn't bring them any benefits, they wouldn't do it. So a lot of the times we are increasing our capital expenditure when we need to grow and when we need to increase our production capacity. So let's say our factory can now produce 500 units, but as we're growing, customers know us, they are buying more and more. We need to increase our production capacity to, let's say, 1,000 units. Maybe we're going to buy a new factory, bigger factory, or better machine that perhaps can produce more. A lot of the times, the reason behind it is to improve efficiency, to make use of the latest technologies which appeared on the market, and also even to replace some old equipment that we have. So the word obsolete can mean worn out, it can mean outdated, obsolete. In Czech, the Czech translation would be zastaralý. Okay? Zastaralé vybavení would be obsolete equipment. And obviously, when there is changing legislations, there are a lot of new regulations, either when it comes to safety of our workers, or often even environmental regulations, green technologies. If we want to keep up with the change, then we also need to spend or invest more and increase our capital expenditure and to be able to comply with that. So why don't all businesses invest in long-term assets? What is sort of holding a lot of businesses back? If it's so great, if it's so cool to invest, there are a lot of reasons for capital expenditure. Why do you think? So because the answer is because a lot of these long-term assets are usually very expensive. Remember the examples that I showed you: land, buildings, equipment, machines, vehicles. Because these are expensive assets, very much it is a strain for the business to actually find the source of finance. How are we going to pay for that asset? It would be a great investment, but where are we going to find our money for it? If it's a sole trader, then as we're going to see later on when we talk about sources of finance in the next chapter, the sole trader's access to capital is going to be limited. It will probably be limited just to some personal savings or fundings from friends and family. But how are you going to buy a whole factory or a whole big machine to improve and grow your business? This is going to limit small businesses, and even big businesses are going to need to think very well where they're going to get the finance from. So this is a whole new chapter. That's why we're going to talk about sources of finance separately. But just to answer this question here when we're talking about capital expenditure, it's not always happening. Not every business has high capital expenditure because they simply just cannot afford it. Now, the second type of expenditure that we talked about is revenue expenditure. So this would be finance spent on the daily operations of a business. Okay, the expenses, or it can be also defined as expenses, which are incurred as a result of producing goods and services. These goods and services then in return generate revenue, and that's where you get the name from. A revenue expenditure, if I say it in normal non-business terms, is simply spending money in order to generate revenue. So revenue spending in order to get revenue. So in order to earn money, you need to spend money. Have you heard that pronoun? Sorry, that pronoun. Have you heard that phrase? Proverb. Have you heard that proverb? In order to spend money, in order to make money, you have to spend money. So this is exactly what revenue expenditure is about. Some examples. What do we need to spend money on in order to produce our goods and services? The pictures are already going to give you a hint. One example would be, wages and salaries. Also, it could be raw materials, rent. I can, if I don't, you know, mm, if I don't need the premises that I'm renting, perhaps because I stop producing my goods, then next day I will just stop renting it and my revenue expenditure will go away. So rent is actually very flexible. That's why it's called revenue expenditure. You can stop paying it any time. But if you buy a building, you're going to be stuck with it. So capital expenditures for long term, but revenue expenditures is you can get rid of it very easily in the short term. Utility bills, insurance, or advertising spending. These are all examples of revenue expenditure. And the idea is that a revenue expenditure should generate value to the business today. Okay, it should generate value as it happens rather than in the future. So the idea, if I'm going to hire a worker, I'm spending money on their salary, but you should pick such a worker that actually generates more money for the business than what business spends on the worker, right? So this is the sort of distinction between revenue expenditure and capital expenditure. Capital expenditures in the long term is the long-term spending for more sort of investment assets, and whereas revenue expenditure is spending on daily operations of a business that help us generate revenue today. The key concept that is revolving around this topic, and that you can be referring to, for example, in your IA, if you're talking about this topic, is the topic of change, is the concept change. And just think about, like, how is capital expenditure going to be affected by change? Probably because new technologies are evolving every day. We're going to have newer equipment, often invest into newer equipment so that we don't use obsolete one. We're going to have to keep up with some new trends to stay competitive, and so on. So this is one example of how change plays a role in this topic. And for example, when it comes to revenue expenditure, well, think about our workers as an example. In order to motivate them and in order for them to stay in your company and not another company, you might need to offer new and better remuneration packages, which basically just means new incentives, whether it's monetary benefits or some other benefits like improving your workplace and offices. You're going to have to think about that and spend on that in order to keep your workers satisfied and keep your company going. In your textbook, there is a short excerpt talking about different businesses that didn't innovate, that actually went bankrupt. And it might be interesting, if you haven't settled on your IA just yet, to maybe have a look at those ideas, have a look at those businesses, and maybe see and research what were some reasons why these businesses failed. Was it because they didn't have enough capital expenditure, because they weren't innovative enough, weren't spending on new equipment, etc., or perhaps that they weren't spending enough on their revenue? And this is in short the role of finance for businesses. So finance, is spent on either capital expenditure or revenue expenditure. And in the next chapters, we're going to see where where the businesses get their finance, what are the sources of finance, and how businesses are using these sources of finance. So that's it, and have a nice day.